Welcome to the SmartKeys podcast. Today, we're diving deep into a resource that focuses on a concept that is just absolutely critical to profitability and growth right now. Value-based pricing, VBP for short.
It really is, and it's one of those concepts that sounds simple in theory, but, it can be incredibly difficult to get right in practice.
Right.
When we talk about VBP, we're really talking about a fundamental shift. It's a strategic pivot away from that simple, almost backward-looking cost-plus model.
Just add 20% and call it a day.
Exactly. This strategy is all about setting prices based on what customers truly perceive they're getting, not just marking up what it costs you to make it.
And that distinction is, well, it's everything. So our mission for this deep dive is to give you the strategic insights, but also the practical blueprints you need to actually master VBP. We're really treating this source material as a guide for any professional looking to, future-proof their business.
And the relevance is, I think, twofold. VBP is essential for capturing more profit. I mean, the absolute maximum the market will bear. And maybe even more importantly, for building real customer loyalty over the long term. This approach really shines when your product is unique, or it's highly differentiated, or it delivers an experience that, say, raises the buyer's status or their self-image.
Which immediately brings up the investment side of it. This isn't cheap or easy. Success here means you have to invest and invest deeply in customer research, in flawless communication, and getting that cross-team alignment on what value even means.
That's the key. You can't just change the sticker price and hope for the best.
No.
If you're still just relying on internal guesswork, you're not doing VBP. You're still in the cost-plus world. You need the input to justify the output.
Okay, let's unpack that, because this is where it gets really interesting. How do we start to define and, more importantly, actually quantify that thing we call perceived value?
Well, great pricing. It always starts and ends with the benefits you deliver, not the features you list. So you have to anchor that price ceiling to perceived value.
And that value has to come from somewhere.
Exactly. It has to be captured from real research, from customer feedback, from observed behavior. This isn't just about a focus group. It's about digging into the outcomes customers actually care about.
The outcome sets the ceiling. So if the customer perceives the outcome is worth $1,000, you can't realistically charge $1,500. You have to identify if that outcome is saving them time or limiting downtime, or maybe it's the prestige that comes with the brand.
You're translating those gains, both the tangible and the intangible, into a price the market will tolerate. And that leads to a really critical psychological point the source makes. The price itself is a signal.
Yes.
For some products, especially high differentiation ones, a higher price can actually signal superior quality. Think about luxury watches. Part of the value is the high price.
I really like the simple example the source used with the laptop screen. It's so tangible.
Yeah, that's a great one.
You increase the screen size, which only marginally increases your component cost, right?
Yeah.
But if that bigger screen drastically improves the user experience, it can raise the perceived value enough to support a much, much higher price.
Yeah.
Far beyond the actual cost of the screen itself.
That example just perfectly captures the VBP mindset. But to operate a system like this, you need very clear boundaries. You need definitions. So you have to focus on two critical metrics here.
Okay.
The first one is willingness to pay, or WTP. That is the absolute maximum, the ceiling. It's the highest price a customer will tolerate before they just walk away.
And on the other end, the lower boundary.
That's the willingness to accept, or WTA. In the context of your supply chain, it's often called willingness to sell, or WTS.
So that's supplier's floor.
It's the absolute minimum price your suppliers need to cover their costs and get their own margin. That sets your floor.
So the entire space between WTP, the max the customer pays, and WTS, the minimum your supply chain needs, that whole area is the total potential economic value being created.
That's exactly right. And how you divide up that value, that's where the strategy comes in. And here's the thing. When the price you set is strategically below the customer's WTP, that gap is where you create what we call customer delight.
They feel like they got a deal.
Precisely. You could push the price right up to the WTP limit to maximize profit, sure, but you risk sacrificing that delight, that loyalty. It's a fundamental trade-off.
It sounds like we need a way to visualize this, because you're juggling at least 4 shifting points here. WTP, price, cost, WTS. That's a lot to track mentally. How do we manage that day to day?
This is where the value stick framework comes in. And it's such a fantastic tool because it turns what is often a really complex, ambiguous problem into a clear, repeatable model that teams can actually use.
Okay, so talk me through the structure of the stick. It plots those 4 points we just defined.
It does. It plots WTP, price, cost, and WTS. And when you plot them, they create three very distinct, very strategic wedges that show you exactly where all that economic value is going. Think of it like slicing up the pie.
Okay, let's look at those slices. Starting from the top, you've got
You have the customer delight wedge. This is the space between WTP and the actual price. If this wedge is wide, your customers are happy, they feel they got a bargain relative to what they valued it at. That builds loyalty.
and the next wedge, the one that's most important for the business itself.
That would be the firm margin wedge. That's your profit. It's the space between the price you set and your internal cost. That's the lifeblood.
And finally, that bottom slice, the one I think gets overlooked a lot, the supplier surplus.
Correct. That's the wedge between your costs and the WTS, the minimum your supplier needs. And if you squeeze this wedge too tight, yeah, you might get a short-term cost win, but you're introducing huge long-term risk. Quality, reliability, all of it.
So this framework kind of forces you to set some guardrails. You have to keep that customer delight wedge healthy, and you have to carefully watch the cost versus WTS relationship so your suppliers stay healthy too. The value stick just makes it all visible.
That visibility is where the strategic power comes from. And what's so fascinating is that once you see it laid out like this, the framework reveals four very clear, very actionable levers you can pull to grow your profit and the total value.
Okay, let's get into those levers, because this is the blueprint. What's the first, most obvious one?
The first is simply to raise prices. But this only works if you have clear, defensible differentiation and demand is tight. If you raise prices without also raising WTP, you're just shrinking the customer delight wedge. You risk churn. So it has to be done carefully.
Makes sense. So the second lever has to be on the customer side of things. How do you get customers to value your product more?
You raise WTP. You do that by actively enhancing the perceived value. Maybe you add new features that solve a real pain point, or you bundle in services, or you just dramatically improve the user experience, the UX, to make it easier to use. That expands the entire top of the stick.
Then the third lever, that's more about internal efficiency.
Right, lower costs. Process improvements, smarter procurement. This lever directly widens your firm margin without changing the price, so it's a pure gain. But you have to be careful that those cost cuts don't compromise quality, which could lower WTP.
And the fourth one, lowering the supplier floor, that one feels like the trickiest.
It is, and it's often misunderstood. You can strategically lower WTS, your supplier floor, but you can't do it by just beating them up on price. You have to give them something they value.
Like predictability.
Exactly. Long-term contracts, guaranteed volume, shared investments that lower their own costs. A stable order book is incredibly valuable to a supplier, and it can allow them to lower their WTS, which in turn lets you lower your cost and widen your margin.
So this framework really demands a dashboard, something that tracks all 4 points, WTP, price, cost, and WTS, so you can test which lever works best.
You absolutely need the data. It moves pricing from, an annual exercise to a dynamic, continuous strategic capability.
Building on that, where does VBP work best in today's market? I mean, you can't apply this to everything.
No, you can't. It really performs best in markets with high differentiation. If your product is easily copied, you're probably going to be stuck in a commodity trap. VBP thrives where there's prestige, craftsmanship, or, proprietary tech.
The handcrafted watch, the boutique consulting service, the price itself signals something about the quality.
And you can contrast that with a true commodity like basic flour. There's almost no differentiation, so the customer sees them as interchangeable. Margins get pushed to the floor. The most interesting plays happen somewhere in the middle.
Like the example of branded ecosystems the source uses.
Yes. A specialized cleaning system, for instance. The initial device isn't a luxury item. But if it uses proprietary replacement pads, you can charge a premium for those refills.
The convenience and the perfect fit raise the perceived value for those existing customers.
Exactly. It lets you capture that upside over the product's lifespan.
So to really implement this, it sounds like you have to force a shift in conversation inside the company, moving away from just listing features to articulating quantifiable outcomes.
That is absolutely essential. You have to translate those tech specs into clear, measurable benefits. You have to quantify it. Customers pay for a solution, not a spec sheet, and you have to prove it.
So to get started, the source suggests some specific research methods. You identify your key segments and then use things like conjoint tests or even simple win-loss interviews to find those, say, 3 to 5 features that really move WTP the most.
Right, you have to focus. And that research has to translate into action, which brings us to maybe the biggest hurdle of all, cross-functional alignment.
Ah, yes, the classic problem.
It is. Product wants more features, sales wants the lowest price to close deals, and finance wants maximum margin. Their goals are often in conflict.
So the value stick and the data dashboard become the common ground, the mediator.
They have to. It must be a mandated cross-functional effort. Product, marketing, finance, sales, they all have to agree on the hypotheses, the guardrails, the success metrics. The source strongly recommends quarterly reviews where the teams report on WTP, price, cost, and WTS, so everyone is working from the same playbook.
And when you start, you have to pilot it. You don't just flip a switch on the whole catalog.
No, that's how you fail. You run small tests. By cohort, by market. And crucially, you create clear, good, better, best ladders, or tiers. That tiered structure lets customers self-select, nudging them into higher tiers without completely cannibalizing your entry-level offers.
So if we connect all this to the bigger picture, to long-term growth, VBP offers some pretty significant advantages. It's not just about profit this quarter. It's about supporting higher price points long-term, lifting your brand value, and deepening that customer loyalty.
And the key to making it all stick once you set the price is communication. You have to relentlessly reinforce the value, not just talk about the price.
You have to lead with those tangible outcomes, the time saved, the performance gained, and then use proof, like case studies or metrics, to back it up. If you're going to raise a price, you have to anchor that increase to a clear improvement.
Right. It prevents the increase from feeling like a penalty and reframes it as added value.
But what do you do about that inevitable segment of really price-sensitive buyers? How do you handle them without undermining your premium brand?
You have to segment your audience with intention. You can offer entry-level tiers or bundled deals, but you restrict those offers only to the buyers who absolutely need them. That strategy protects your brand equity for the segments who are willing to pay for the full value. You never want to water down your main offer for everyone.
So what stands out to you as the most practical next step for someone listening right now who's thinking, okay, I'm in, but this feels huge?
I think the source champions a very pragmatic, learn-fast approach. Don't try to overhaul everything overnight. Instead, pick one high-impact segment, run a small pilot with clear success metrics, and just learn. Or even simpler, pick just one lever. Slightly raise the price on one tier or add one high-impact feature and just measure the result before you scale it.
That feels much more manageable. So you now have the blueprint and anchor price and what your customers truly value, using the value stick to balance that delight, your own margin, and your supplier relationships over time.
Indeed. And the fundamental challenge for everyone is ensuring your pricing strategy adapts, because market perceptions of value are not static. They shift constantly. This isn't a one-time project. It's a continuous capability that, frankly, defines market leadership.
That was a deep dive into mastering value-based pricing for long-term profitability and growth, a really essential framework for anyone looking to optimize their business.
Thank you for tuning in to the SmartKeys podcast.
We really encourage you to read the full article to get an even deeper grasp of these concepts, especially the methods for quantifying WTP and managing that team alignment. You can find a link to the full article in the show notes.
And please subscribe to the SmartKeys podcast for more actionable insights designed to help you work smarter and stay ahead.